Are we on the brink of another financial crisis, like the one in 2008? In this video, we will examine the current state of the global economy and discuss the recent collapse of Silicon Valley Bank. We'll explore what happened to the bank and what this event could mean for the financial system as a whole. By the end of this video, you will have a better understanding of the current financial landscape and the potential risks facing the global economy. So, stay tuned to discover why the collapse of Silicon Valley Bank could be a warning sign of a much bigger problem. The very first place to start would be in the spring of 2020, a time when governments around the world had their hands full with the COVID-19 pandemic, and nobody knew exactly how it would affect the world economy. COVID hit everybody hard, and many governments, afraid for the economic future, began adopting drastic political measures. One such measure was the stimulus packages in the US. It started with Trump, and Biden continued. They were just handing free cash to US businesses and citizens. So the volume of savings in the US skyrocketed. An estimate showed that Americans accumulated excess savings of more than $2 trillion in just 1 year. But what could the people buy with the money? Everyone was home and spent less, so they put the money in banks. Deposit levels began to increase drastically, and banks were getting their hands on more money than they knew what to do with. But one bank got more money than anyone else: Silicon Valley Bank. The bank multiplied its deposit volumes by more than 3 times. That's more than twice the average increase other Northern American banks got. Silicon Valley Bank had only about $60 billion in deposits before the pandemic began. After the pandemic, it became $200 billion. But why was everyone giving their money to Silicon Valley Bank? Simple. It was the favorite bank among North American tech startups. The bank offered loans on good terms to startups in exchange for depositing their savings there and working with them. And 2020 and 2021 were really good years for tech companies. They made a lot of money. And of course, the more money they made, the more they deposited with SVB. It was a win-win for everybody. There was just one problem. In normal banking practice, when conventional banks have huge deposits, they could lend them to families and companies through mortgages, credit cards, or personal loans. But Silicon Valley Bank was neither a family nor a conventional company bank. It was a full tech startup bank. It had so much money, but it had nobody to lend to. A simple option is to let the money lie, but it would have caused them to lose money. Banks' business is to take money from their customers and invest it in loans or assets such as stocks or treasury bonds. If SVB had let the money lie without investing it anywhere, they wouldn't have generated any positive spread or profit to share with their investors. So they devised a strategy to solve their dilemma, investing in mortgage bundles and debt bonds, simply known as HTMs. HTMs gave the bank a fast, secure, and long-lasting fixed interest rate. This way, SVB earned almost a 1.5% spread without doing anything. It was free money, and SVB couldn't get enough. It invested more and more in these types of assets. It even purchased another bank dedicated to real estate to increase this type of investment further. And everything was going smoothly, at least for a while. In 2021 and early 2022, inflation hit the West, and with it came the notorious interest rate hikes. As soon as that started, things began to get very ugly for Silicon Valley Bank. Their main clients, tech companies, began raising financing with many problems. Their main funding source was private investors. With interest rates rising, investors were no longer investing in tech companies. They were now taking their money to other investments with better risk returns. When tech companies lost the backing from private investors, they all came for their money simultaneously. At the same time, other competing banks began to offer higher yields on deposits, and with that, SVB lost even more clients and money. It was almost an overnight event, but the bank needed help to afford to lose its customers. Most of the money that customers had in the bank was already invested in long-term mortgage packages. In other words, the bank needed to have its clients' money at hand. If more customers came for their money at the same time, SVB would be in a lot of trouble. Of course, they could have sold those mortgage bundles and converted them into cash to pay back their customers. But there was another problem. Their mortgage and long-term investment packages had a fixed rate interest rate of 1.72%. That interest rate had lagged far behind. It was very low. In other words, if Silicon Valley Bank wanted to sell its bundles to raise money, they would have to wait to buy them, since they offered very few returns. The only alternative would have been to sell them at a discount for much less. But even if it did, it would have needed more money to pay back all its customers. There was only one option left, a Hail Mary by every standard. If the Silicon Valley Bank would survive, it had to prevent its customers from withdrawing their money. And how could it do that? By raising the profitability of deposits. And that's exactly what it did. Suddenly, it started paying much higher interest rates to its customers so that they would not withdraw their money. And it worked in the short term, but in the long term, there was another problem. The interest paid to customers on their deposits had to be increased so much that it exceeded the interest received on the bank's long-term investments. In other words, the bank began to have a negative spread and lose money on its investments. But that's not even the worst thing. As interest rates continued to rise, all the losses increasingly eroded the bank's financial capacity until the situation could no longer be managed. But this is not the end. The bank's managers came up with a plan to solve the problem, and it involved two key moves. First, they decided to sell some of their investment packages to the market for about $21 billion. This would allow them to reinvest the money from the sale into buying assets that yielded higher interest rates so that they could solve the spread problem, while also increasing the liquidity cushion in case things got worse. It was a really good plan, but if they were selling, it had to be at a discount. So with the sale, the bank would lose $1.8 billion. It was too much money lost to be tolerated in regulatory terms, so the bank had to compensate for them somehow, and that is what their second move did. They introduced a capital increase. The capital increase meant that they would be asking for more money from the bank's owners or potential owners. Significantly, the bank proposed a capital increase of $2 billion. And on paper, it seemed like a good concept. The $1.8 billion loss would make up for the $2 billion, which would also increase the financial safety net. In fact, at this point, the bank's situation was not all bad. With that capital increase, it could have gone ahead with far fewer problems and even started earning money again. But one more thing happened that made the bank head for disaster, something that caused this restructuring plan to fail. Theoretically, a capital increase was a good idea, but it could mean doom in practice. Asking for a capital increase is an admission of serious problems in the banking world. If customers realize they are at risk of not getting their money back, they will immediately come for their money. And that's exactly what happened to SVB. On Thursday, the 9th of March 2023, after the world got the news of the capital increase, all hell broke loose as several big names in the tech world started spreading panic and telling everyone to get their money out of the bank. One of them was Peter Thiel. Upon hearing this, customers began to realize that the SVB could be in danger, and they came en masse to take their money out of the bank. And then absolute panic set in. Other banks like JP Morgan also seized the opportunity and started making robocalls to convince customers to withdraw their money from the Silicon Valley Bank. The result of all this chaos and banking panic was that in just one night, Silicon Valley Bank customers withdrew a whopping $40 billion. That is almost 25% of the bank's entire assets. A completely unaffordable figure forced the authorities to intervene and declare bankruptcy. On the 10th of March 2023, just one day after panic swept through Silicon Valley, the US banking authorities took control of SVB. They have since then made several announcements. The first is that no depositor or company will lose its savings. The second is that the Federal Reserve will open new liquidity channels so the panic doesn't get to other banks. And the third is that the shareholders and bondholders of the Silicon Valley Bank will lose all their rights. So what happens now that SVB is under the control of the authorities? Ideally, a larger bank would buy Silicon Valley Bank and take over all its debts and deposits. HSBC Bank has already brought the UK branch, but if nobody buys the bank, the authorities will sell all the bank's assets and distribute them among customers. And if money is missing, a special bank tax will be created to cover the additional costs. Like the story of Icarus, SVB, filled with hundreds of billions, flew too close to the sun. And the crash, albeit due to a series of unfortunate events, was a great one. Unfortunately, SVB is not alone in this. The country is in economic unrest, affecting every aspect of our living, from food to finance to housing. If it got the giant SVB, then no one would be safe. And that's it. Be sure to catch our next video featuring more authentic stories from the most influential companies and top brands.